Hey, welcome back. Today we're diving into the topic that many property owners ask about: how converting your rental property into a primary residence impacts your taxes, especially when it comes to depreciation recapture. If you've rented out your property and now you're thinking about making it your home, you're going to want to stick around. So here's the deal. When you rent out your property, you're likely taking depreciation deductions on your tax return. Depreciation is basically a way to account for wear and tear on the property, which helps reduce your taxable rental income. But when you convert that rental into your primary residence, there's an important tax rule you can't ignore: depreciation recapture. What's depreciation recapture? Well, the IRS allows you to depreciate your rental property, but when you sell the property, they want some of that tax back. This is called depreciation recapture. It's a taxed differently than regular capital gains. It's slightly higher, 25%, which is a compromise to not recapturing your full ordinary income, but not getting capital gains treatment on it. So under Section 1250, any gain on the sale of the property that can be attributed to depreciation deductions you've taken while the property was rented out must be included in your taxable income. And as we said, it's 25%. So it seems like it's more than the capital gains, which it is, but it's a compromise that you don't have to recapture it at your ordinary income. So it feels like a lot, but it's actually kind of a break. So let's give an example. So let's say you purchased a rental property for $300,000, and over the years you've claimed $50,000 in depreciation. Now you convert that rental into a primary residence and later sell it for $500,000, hoping for your exclusion. You might think you're getting a $200,000 capital gain, but it's not that simple. Out of the $200,000 gain, the IRS will look at the $50,000 you depreciated while it was rented. That $50,000 is subject to depreciation recapture, and you'll be taxed on it at the maximum rate of 25%. Well, will be 25%. Even if you're eligible for the Section 121 home exclusion on the rest of the gain. So while you might exclude some of the capital gain under Section 121, the depreciation recapture is still going to apply. It's also important to know that this rule applies regardless of how long you've used the home as your primary residence after it was rented. Even if you live there for a decade after renting it out, the IRS still wants that depreciation recapture. So remember, if you've depreciated your rental property, be prepared for depreciation recapture when you sell, even if it's been converted into your primary residence. Recapture rate is 25%. Section 121 exclusion, where you can exclude up to $250,000 or $500,000 for married couples of capital gains on sale of your home, does not apply to the portion of the gain tied to the depreciation. Again, like our example, if you had $200,000 in gain, but you have $50,000 to recapture, you can exclude all of it, but that $50,000 is still going to be recaptured. So if you're thinking about converting your rental into a home, make sure to factor in this tax rule. A little planning can help you avoid surprises when it's time to sell. And as always, I recommend talking to someone about your specific details. Hope this clears up the rules on depreciation recapture when converting a rental property to your residence. Don't forget to like, subscribe,